For most of modern history, inequality was treated like bad weather. Unpleasant, sometimes dangerous, but ultimately natural, something markets would smooth out over time, something growth would fix, something not worth obsessing over as long as the overall economy kept expanding. Then one economist did something deceptively simple. He stopped looking at decades and started looking at centuries. Welcome to the Financial Historian, where money, power, and history collide, and nothing is ever as simple as it looks. This is the story of Thomas Piketty and why his work quietly dismantled one of the most comfortable assumptions in modern economics, that capitalism naturally spreads wealth over time. This is not a story about ideology. It's not a story about left versus right. It's a story about what happens when you follow the data long enough that the usual excuses stop working. For most of the 20th century, mainstream economics focused on growth, productivity, output, efficiency. If the pie got bigger, the thinking went, everyone would eventually get a larger slice. Inequality, if it appeared at all, was framed as temporary, a phase of development, a side effect of progress, or a measurement problem that would correct itself. And for a while, history seemed to cooperate. After World War II, inequality fell sharply across much of Europe and the United States. Wages rose, middle classes expanded, homeownership spread, wealth concentration declined. Economists looked at this period and quietly assumed it was normal, the natural outcome of advanced capitalism doing what it does best. But that assumption rested on a very short memory. Piketty's insight wasn't philosophical, it was archival. Instead of starting with theories, he started with records, tax archives, state data, income statistics, national accounts, not just from one country and not just from one era, but across multiple nations going back hundreds of years. And when he stitched that data together, a very different picture emerged. The post-war period wasn't the rule, it was the exception. For most of modern history, wealth had been far more concentrated than economists like to admit. The 19th century, the era of Jane Austen novels and industrial expansion, was not a story of rising opportunity. It was a world dominated by inherited fortunes, where capital ownership mattered far more than work. The sharp decline in inequality after 1914 didn't happen because markets suddenly became fair. It happened because capital was destroyed. Wars wiped out fortunes, inflation erased debts, taxes rose dramatically, governments intervened at scale. Equality didn't arrive politely, it arrived violently. And once those forces faded, inequality began doing what it had always done before. It started rising again. This is where Piketty posed his central question, the one that made people uncomfortable. Why does wealth tend to concentrate over time, even in democratic market-based societies? Not as a moral question, as a mechanical one. To answer it, Piketty made a crucial distinction, one that sounds obvious once you hear it, but changes everything when you actually think it through. He separated labor from capital. Labor is what you earn by working. Wages, salaries, income tied directly to effort and time. Capital is what you own, assets that generate income simply by existing. Land, housing, stocks, businesses, bonds. And here's the quiet asymmetry at the heart of the system. Labor has limits. You can only work so many hours. You can only increase productivity so fast. Your income rises slowly, if it rises at all. Capital doesn't face those limits. Capital compounds. It doesn't need to work harder next year. It doesn't need to negotiate, retrain, or show up on time. It just needs to exist. This is where Thomas introduced the idea that would follow him everywhere, often reduced to a slogan and often misunderstood. When the average return on capital consistently exceeds the growth rate of the economy, wealth accumulated in the past grows faster than income earned in the present. That sentence sounds technical, but the reality is simple. If you already own assets, your wealth tends to grow faster than the economy itself. If you don't, you're trying to catch up to something that's accelerating away from you. This isn't a conspiracy, it's arithmetic, and over long enough periods of time, arithmetic wins. Piketty showed that this dynamic wasn't theoretical, it was visible repeatedly across countries and centuries. Before the 20th century, inherited wealth dominated economic life. After the shocks of war and policy intervention, inequality fell. Then, as growth slowed and capital recovered, the old pattern reasserted itself.
The data didn't suggest a temporary glitch, it suggested a tendency. And this is why his work landed so hard when Capital in the 21st Century was first published, because it quietly challenged one of the core stories modern societies tell themselves, that inequality is mainly about effort, skill, or merit, and that markets naturally reward contribution over ownership. Piketty wasn't arguing that markets don't create wealth. He was showing that markets are very good at preserving and amplifying existing wealth, especially in low-growth environments. When growth is high, wages can rise alongside capital. When growth slows, capital keeps compounding and labor gets quieter. This is where the human consequences start to show. Rising housing prices benefit owners, not renters. Stock market gains reward those who already hold assets. Inheritance matters more when returns compound faster than incomes. Opportunity becomes less about talent and more about timing, specifically whether you were born before or after assets became expensive. Compound interest doesn't care how hard you work. This is also why Piketty unsettled people across the spectrum. For critics, his work seemed pessimistic, too deterministic, too dismissive of innovation and mobility. Surely new technologies, new industries, and entrepreneurship would disrupt old fortunes. And sometimes they do. But Piketty's point wasn't that mobility is impossible, it was that at the system level, it doesn't cancel out the underlying tendency. Exceptional stories don't define average outcomes. Supporters, on the other hand, saw something else entirely, a long-term map of how money and power interact over time, and faster than it erodes assets. When asset prices rise alongside inflation, or faster, inequality can widen, even as policymakers claim success.